B207B, Shaping Business Opportunities, Part 2. We are in week 9. This is block 3. Can you remind me what was the title of block 3? Do you remember?
It was about globalization.
That was block 2.
Block 2.
Title. We are done with block 2. Everything you took for block 2 will be included in the midterm exam. So now we started, last time we started block 3, and it was, do you remember? The long-term success of organizations. All right, so today's class will be related also to the long-term success of organizations. We will discuss today a business function that we haven't visited yet in this course, which is accounting. And we will discuss a particular topic, accounting for values, creating value in the long term. How are we going to create value through accounting? Because through measuring certain things in the business, we will be able to show or to create more value for the business. Basically, we will be looking at 2 basic concepts, HCA and FVA. Historical cost accounting and fair value accounting are the 2 main concepts we will discuss in this session. We will come at explaining them and you will know what they mean. So what are the learning outcomes of this session? We will explain how shareholder value is created. We will understand how different financial reporting measurements work. And also, we will look at the arguments for and against the key measurement bases. What are the key measurement bases? HCA and FVA. Okay, so these are keywords for now that you need to keep in mind as we are discussing today's chapter. So first of all, shareholder value. What does shareholder mean? So it's basically the owners of the organization. Anyone who has a share in the organization is an owner. So usually the main purpose or the main objective of a business is to maximize not only the profit, but also to maximize the value of this organization. So not always you want to get the profit as in cash. Sometimes the profit will be reinvested to make even bigger value in the organization. So if you are the owner of an organization, you might not cash out your money now. You might leave your money grow in the same business in order to have more money when? In the long term. Okay, so this is the link here between the long-term success, which is the title of block 3, and what we are saying here in this particular chapter. Okay, always make the link between the block and the chapter. So for shareholders, most of the times what they are interested in is not making money now, but is growing their money over the long term. But increasing shareholder value is a management decision because it's the managers, the executive directors, it's the people who make decisions in the organizations. They are the ones who actually decide what's happening in the organization. So the shareholders are not always the managers. Shareholders are owners and managers direct and directors, they direct the business. So the shareholders appoint the managers to act on their behalf, and they expect the managers to behave in a certain way that is good for their interests. Okay? However, what's the problem here? Managers not always look for the long-term success of the organizations because they are employees, because they might not be there in a year or in 2 years or in 10 years unless they are very motivated to stay in the organization, unlike the shareholders who own the business. So conflicts arise between shareholders and management over the short and long term. This can occur as managers sometimes want to take the short-term decisions because they want to close this quarter very well. They want to increase their bonus because their bonus is related to the short-term sales of the organization. So we have this conflict here between the managers and the shareholders of the organization. Absolutely, they take a strategy, but the decision making is in the hand of the managers. Okay, sometimes we have a conflict of interest here between. Let me give you this example. So for this quarter, the manager wants to achieve a certain quota, a certain sales level. Okay, so he or she will make a big sale on some items in order to increase the revenue. Okay, this might be not a good idea on the long term for the long-term reputation of the business. So see how sometimes there is a conflict between. Yes, who puts the plan? The managers. All right. So sometimes conflicts happen. Of course, shareholders do have the ability, they do have the power to replace the managers or to tell them to do otherwise, but most of the times the managers are the ones who will take, or directors, they are the ones who take the decision. So one of the problems of creating shareholders' value caused by companies focusing on the short term. So if a company focuses on the short term, then it will suffer from poor performance in the long term. If you only focus on the short term, okay, we should have plans. As we said last time, we should have plans to focus on the long-term success. And sometimes you have to delay the gratification till later. Yani delay receiving some of the profit, delay it till later when you can get even more later on. Okay? The managers should be encouraged to do what? To think long term. Okay? They should be rewarded for doing that. Companies should think creatively and not focus on financial engineering only, but focus on achieving the right reputation and having the right route for the long term. Companies should reward long-term thinking, and senior executives should bear the risks of ownership as shareholders do. This is what a lot of companies do when they give stock option for the upper management. They give them stocks, so they become owners of the organization. In this case, automatically they will start thinking as an owner and as achieving the long-term success of these organizations. So here we have, if companies align their internal performance measurement systems on short-term profits or accounting returns, this is also not a good indicator of value creation. What do we mean by measurement system? This is what we are going to look into the coming slides. It's the FVA and HCA concepts, which we are going to explain next. So the term measurement can give a misleading impression of certainty and objectivity. So let's talk about this concept of measurement for a little before we jump into what HCA and FVA. Imagine that 3 years ago, your business has bought a building. Okay, it's a 3 or 4 level building. So you have bought the building for 2 million riyals. three years ago. Now, how do you measure or how do you record the value of the building on your sheets, on your financial statements? What do you think? Now, keep in mind that this building is part of the wealth of the shareholders. Who owns this building? The business, and the business is owned by the shareholders, right? So the shareholders are the owners of this building. So if you have 4 shareholders, these 4 shareholders own the building. The value, depending on how much you record, the value of this building on your financial statements will show how rich they are. Correct? So this number is an important number to be recorded on the balance sheet of the business. Correct? Any accounting majors here? Nobody? Okay. So the balance sheet is where you record all the values of your assets. Okay, it's the financial statement that shows all the assets of the business. Okay, now here comes the measurement issue, and we have 2 different approaches to measure this building. So how would you do it before we start? How would you do it? Yeah, because every year you have to update your balance sheet, right? And 3 years ago, you bought the building for 3 million riyal. Did I say 3 or 2? 2 million, whatever. Okay, 2 million riyal. So yeah, so we have 2 options. You can either use the original price that you have bought it for, which is 2 million, or you could use what? Yes, absolutely. The new value of the building. It could be either less or more than the 2 million that you have paid 3 years ago. Okay? In general, okay, of course there are exceptions. In general, over time, over the long run, real estate prices go up, right? But if you have other types of assets, like a machinery or a car or a factory, for example, over time, this type of asset will go down. As you use a car, the value of a car goes down, right? So the value of assets change over time. Okay, very rarely that you will see that the value of an asset will remain the same over the years. It will always change. So how you are going to change it will reflect on the value of the business. And in turn, will reflect on how rich your shareholders are. Correct? So this is why this whole chapter is called, this whole topic is called the measuring. This is a measuring issue. You could show your shareholders to be very rich, or you could show on your sheets that they are very, not rich. Okay? Of course, we have rules. Accountants have rules to follow. Definitely, there are things that they can do and they cannot do. But here we have 2 different types of measurement: historical cost and fair value cost. Okay? What does historical cost? It takes, exactly, it's so from the word, it takes the history into consideration. It's the approach favored by most accountants. It records the value of an asset as the price at which it was originally what? Purchased. So you have purchased the building for 2 million. This is what you record on your sheets. Okay. In contrast, fair value accounting, as the name implies, identifies the actual market value of an asset or liability at the measurement date. So how much is it worth now as I am measuring it. How much is my building worth now? Is it worth 2.5 million? Okay, then I need to update that. This is what fair value accounting means. Now, just like any other issues in business, each method or each way has its own positives and negatives. So we have arguments for and we have arguments against each way, all right? So for historical cost accounting, so this is HCA, we have arguments for and arguments against. Pros and cons? Pros and cons, exactly. Okay, so what are the pros for historical cost accounting? It's very objective. What does objective mean? No, objective means you and I cannot disagree on it. We cannot disagree because historically it's written here on a piece of paper how much we have paid for it. Okay, we cannot disagree. It's there is a clear audit trail, and amounts can usually be proven by documentation. We have a document that proves how much we have paid for the building. Okay, no two people could disagree on it. Now, what are the arguments against? What do you think are the cons? Okay, yeah. What are the arguments against HCA, historical cost accounting?
You can say that some problems might happen in the shareholder. They couldn't agree on something specific.
Not really irrelevant to what we are saying here. What's the point that we are mentioning? Not really relevant. What's very relevant is decision making. We need to make a decision, and we can't take into consideration what we have paid for this building in the past as irrelevant information. Why? Why the 2 million that you paid 3 years ago is not irrelevant information for you to make a decision about this building? Absolutely, absolutely. The value of the building definitely have changed. It has either gone up or down. All right. So if somebody comes up to you and says, I want to buy your building for 2.5 million riyal, would you accept directly? No. What do you need to do before accepting? Find out what is the current price, what is the market price for the, even if you will be making 500,000 riyal, this is not enough for you to make a decision. You might be able to, you need to know the actual market price before making a decision. So the conclusion here is that any historic price will not be used and should not be used for decision making. All right? So especially if there is a long time span since the transaction occurred. Okay, so you buy a car today for 100,000, and then next year you want to sell the car. Do you expect to get exactly 100,000 on your car? No. You will expect to receive less. Okay, in order to know what is this lesser amount is, you need to search the market and see how much similar cars are being sold at. Okay, only then you can know the market value of your car. And you will know if you get any offers on your car, if the offers are reasonably good for you or not. Okay, so same concept here. Now, the second point is that the amount paid for an item or received for an item may not necessarily be indicative of its value. Maybe you have overpaid at that time. Okay, so historical cost accounting, the historic cost that you have paid might not be a good indication of what the real value of your asset is. Maybe you got a great deal. Maybe you overpaid. Okay, so anything you paid in the past is not really relevant. What we care about is right now, what it's worth around right now. Judgment involved in determining depreciation rates can create inconsistencies because depreciation has different ways of depreciation. We have different methods of how to reduce the value of a car, for example, or an asset over time. Accountants could use different methods. So two accountants might use different methods for depreciating the same asset. So also, this could create variability in the value. The last point is the inability to determine the cost of some items, as items may be donated with no actual cost to the entity. Sometimes items might be gifted to you or donated to you, so you don't have a historic cost for them. Their value, should you put their value as 0? No, so you need to find the what? The fair. The third one. Yeah. Are you familiar with what depreciation means? Yeah. When the prices go low. Okay. So I buy a car for 100,000. Okay. And there are several ways in accounting that decide how you can make the new value, how you can decide of the new value of your car, of your machine, of your computer, so many things. Okay. The straight line depreciation is the easiest method of depreciation. It basically involves reducing the value of your asset each year by the same percentage or by the same amount. So, example, if your car is worth 100,000 now, I can tell you that your car will work for 10 years, for example, and at the end of the 10 years, your car will be worth 10,000 only. Okay? So how much are you going to use your car? What is the value of money that will be depreciated over 10 years? You buy it for 100,000. At the end of the 10 years, it will be worth 10,000. So how much money are you using in your car? Huh? What's the difference between the 100,000 and the 10,000? 90,000. So basically, it's costing you to drive this car. It's costing you 90,000 over 10 years to drive the car. This is the real cost for you, because at the end of the 10 years, you can sell the car for 10,000. Correct? Okay. So for 10 years, you will use the car. 90,000 worth of your car will be depreciated. So how much every year? 90 divided by 10. Correct? So that's how much per year? 9,000. 90 divided by 10 is 9. You're not that good at math. Okay. So you know the concept. So do you get the idea here? So we say that this is what depreciation is. This is the straight line, the straight method depreciation, which assumes the same depreciation over time for all the years. Okay, we have other methods of depreciation as well that assume different things that are a little bit more complicated. We don't have to go through that now. But understand that accountants have this method and other methods to calculating depreciation. Okay, the methods will give different values for the same assets over time. Okay, so this difference in value over time will create inconsistent results in what? On the balance sheet between different different ways of preparing the balance sheet. Okay. So this will create different value for the shareholders. Okay, again, I want to stress on the importance that in accounting, there are rules, there are regulations that accountants should follow. Okay, يعني, they should follow, but still you could get different results as you are using different ways. Okay, so now we come to the second way, which is the fair value accounting. Fair value accounting, FVA. Remember what we said about HCA? What is the biggest disadvantage? You cannot make a decision with it. What can you make a decision with? Exactly, the fair value accounting. Yes, yes, it's the fair value accounting. So this is why the biggest advantage of the fair value accounting is that it's a relevant measurement approach for decision making. So before selling your building, you need to find out what's the market price around the area, around buildings similar to your building. Maybe you can ask some specialists to assess the value of the building and so on. Okay? Maybe your building is worth 3 million right now. Okay, so based on that assessment, you will be able to make a better decision to sell the building by using the fair value accounting. Also, the fair value accounting is objective if determined by reference to the market price for an item. So you get two different specialists who can give you the market value of your building. If the two prices are very close, it means that this is an objective price. Really, it's a good price. يعني it was assessed well. Okay. Now, what are the arguments against the fair value accounting? It's subjective where a market price is unavailable, where you cannot get a market price. For some items, it's hard to get a market price. Some people give you a very high price, some people give you a very low price. So there is no relevant market price for your asset. Now, the second point is also related to accounting and concepts studied in the accounting major. Basically, when you want to give the value of an item, you assume that you are going to sell the item. Okay? So most of the time, the assumption is that you want to sell it. But sometimes you just want to record the value of your item. You don't want to sell it. So in many cases, the value of your asset, in order to sell it, depends on a buyer. It doesn't depend only on the market, but it depends on a buyer willing to pay this amount for your asset. Okay, so this is the second disadvantage. Also, market prices can be volatile. Prices can go up and down quickly in some markets. So maybe you don't have enough time to always keep up with the market value of your assets. Okay. So here comes to the session summary. What did we learn? We learned that the way you measure things in accounting will impact on the quality of your accounting information. The quality of your accounting information will impact the value of your business. The value of your business will impact the value of the shareholders. It will impact how rich they are or how poor, not rich. Okay, it will impact their wealth. It will impact the value of how much wealth they have. Okay, so if they want to sell the business as a whole, the accuracy of your accounting information will be the big impact or a big factor in the sale revenue of the business. Okay, this will of course also impact the decision of whether or not to sell the business in the long-term value of your shareholders. Okay, so selecting a different base measurement yields different results and illustrates that accounting is as subjective as any other discipline. Your accountants should be extremely experienced and they know what they are doing, because this will impact also the whole business altogether. All right, any questions?